Good afternoon. So I think you know this is economic survey class, and I think there were few classes already done for you related to economic survey. Yeah. So we'll have a detailed discussion today on two areas. One, the preface of the economic survey. Generally, people neglect preface. I think preface is the most important area where the tone of the budget and economic survey is set. Okay. And then the first chapter in the economic survey, which is more like the synopsis of all the chapters. Okay. And the most important chapter is the first chapter for prelims as well as mains. इसको enlarge कर नहीं slideshow. We are far better. Okay. No problem. The topic, what we will do is first we'll focus on the preface, which is very important here. What was the main focus in the economic survey? So there are few technical things. I'll try to simplify them. And I'll also tell you where, if there is an equation, of course, I've not written any equation from the economic survey, but what government has done to increase growth, we'll try to focus there. Anybody from economics optional? No. Okay, fine. So here, when we see this, okay, the very popular picture here. Now you know this, that trade deal has been signed, but the survey was out before the trade deal, right? So the paradox of 2025 is that one is on one side, we have a very strong macroeconomic fundamentals. So what is this macroeconomic fundamental? Economic growth is decent. Inflation is also okay. Current account deficits are fine. Government is focusing on fiscal prudence. Fiscal prudence means FDs are okay. Okay, so government has fixed a target of 4.3% in the budget, 4.3% of GDP. Okay. So in spite of all that, there are certain vulnerabilities which you see. What you observe is the currency stability right now is not linked to our macroeconomic stability. This is what the survey is saying. Currency stability means I'm talking about the rupee value stability is not linked to macroeconomic stability. That means generally stable economies should have strong currencies. But our rupee value was depreciating in spite of macroeconomic stability. This is like a paradox. So here no longer rewards macroeconomic success with currency instability, capital inflows or strategic insulation. Now this is something which you should understand. So what you observe is, though there is macroeconomic stability, currency stability cannot be ensured, number one. Number two, you can't have capital inflows coming in. Almost like April to December last year, 3.9 billion FPIs have moved out of India. So capital outflow is there rather than capital inflow when I'm talking about portfolio investors. And strategic insulation, you can't be insulated from whatever is happening outside India. You can't be insulated. In spite of having macroeconomic stability, these are the problems. This is what you should understand. So what does it mean? Government is trying to tell that our rupee value is not able to depict macroeconomic stability, number one. That means the rupee value is depreciating. That does not mean my macroeconomic stability is bad. Macroeconomic stability is very good. This is what. And so why? This is basically, one is tailwind and headwind. Everybody knows what is headwind. Headwind is something that is hitting you. When you're moving forward, something is pushing you back. This is an headwind. Tailwind, favorable factors that push you forward. This is called as tailwind. So there are a lot of headwinds. That is basically geopolitical tensions. This is what the economic survey is talking about. So headwinds like geopolitical tensions, but at the same time, government can convert it into a tailwind. Tailwind means we will try to focus moving forward, but there should be collaboration between state, okay, private sector, citizen, society. This is what the economic survey is. And the coordination between all this will take me forward. This is what the survey is talking about. So I think the paradox is clear. Okay, so the paradox is something like, though macroeconomic stability is there, there are problems. Okay. Okay. So what can happen? Economic survey talks about three things that can happen. There are three possibilities that can happen. One possibility is the most dangerous possibility is, on one side, economic survey says, there is huge amount of investment that was done in AI infrastructure. Billions of dollars was spent on AI. Okay, number one. And what if AI fails? This is one aspect. That is, basically, if there is a failure with respect to financial, technological, and geopolitical together. This is a very rare situation where the financial means the markets are going to collapse. Technical, you have put huge investments into AI. US has pushed a lot of money into AI. AI is like a bubble. This is what it is talking about. What if AI collapses? This is basically on one side technological, another side financial, and geopolitical. That means the global situations. All together, if they collapse, that's going to be a very bad situation. And that is something like 10% of chance. That is basically a probability of 10%. That is what economic survey is saying. So if you observe here, AI infrastructure failure, $120 billion data center spending, rise in Japanese bond yields, all these are visible. These are little technical in the sense that three scenarios have been assumed moving forward. So, economic survey is trying to tell what has happened and then what could happen subsequently if things go wrong. So there are three scenarios that can happen. One is, the most dangerous one is 10% probability where technological failure will be there because huge amount of money has gone into data centers, AI. So this is like a bubble, whole investment into one segment. If it collapses, then there can be repercussions. Are you able to get this? This is what it is saying. Second, you also have problems like financial, that is the global markets are collapsing. So how can this happen? If you observe the whole globe, the bond yields are increasing. Japan is one such country which used to face deflation. Okay, everybody knows what is deflation. Okay, but in the recent past, Japan is also facing inflation. In Japan also there is increase in bond yields. Bond yield. Okay, so what does that mean? Japan also there is increase in bond yields means basically inflation is there on one side. Bond yields are increasing means people are buying more bonds or less bonds? They're dumping bonds, or they are dependent on bonds. Simple logic. No, this bond prices and bond yields are inversely related. Okay. Suppose if Madam is following fiscal prudence, Nirmala Sitharaman Madam is following fiscal prudence. That means Madam is going to issue less G-Secs in the next year. Issue less G-Sec because she's not going to borrow much. Are you able to get this? If she's going to issue less G-Secs, that means what will happen? Obviously, bond prices. Today, expectation is today bond prices should increase. And therefore, bond yield should decrease. Everybody is able to get this. That means, if governments follow fiscal prudence, what will happen to bond yields? Bond yields probably should come down. So that means, Madam is saying that next year I will only borrow less, or my FD is going to be 4.3% of GDP. I'll not borrow much, means I'll issue lower number of G-Secs in the market. So less G-Secs in the market means there is higher demand for G-Sec. High demand for G-Sec means G-Sec prices will increase. G-Sec price will increase means G-Sec yield is going to decrease. That means decrease in yields of government indicates two things. One, fiscal prudence, which India is showing, number one. Okay, so number two, countries can raise money at a lower cost in the international market. Countries can raise money means I can borrow Suppose Indian bonds are listed in the international exchanges. This is what the economic survey says. Indian bonds are listed in the international exchanges, okay, bond exchanges, okay, and India can raise money not only from India, but from outside India, right? So if your bond yields are lower means government, central government and state government, they can raise money at a lower cost. Is this difficult? No, difficult, easy, not what? Not understood. See, what I'm trying to tell you is, better is the fiscal prudence, lower would be the yield. Is that okay? If my yield is less means, suppose yield is 6, government bond is giving 6% return annually. New bonds, madam can issue at 6% and raise money from the market. That means cost of capital for government raising loan becomes cheaper. Is that okay, everybody? Raising loan becomes cheaper if the yield is less. For example, if government bond is giving 7% return, 7% is the yield. If madam has to issue new bonds, RBI has to issue new bonds, they have to issue it at 7.1. That means what? Cost of borrowing is going to increase. Are you able to get this? Everybody's understood this. That means my cost of capital will be cheaper when the yield is less. Many freshers out here? Is that okay? Not okay, you can tell me, I'll explain it separately, but this is something which you should know, because otherwise we'll not understand what they are talking about. So on one side, AI destruction, if it happens, that means overvaluation, AI collapses. On the other side, yields are increasing. Yields are increasing means borrowing costs are going up, even in countries like Japan. Okay. And then geopolitical situation. Geopolitical situation, obviously tariffs and lot of uncertainty which is there. All three coming together can create hell a lot of problem. This is 10% probability they are talking about. That can happen. Is that okay? Then one more thing is 40 to 45% probability is the world is becoming less coordinated, more inward oriented. Inward oriented means you're looking like more like deglobalization, protectionism, lack of trust. This is what? Risk averse. And this is clearly visible. How is it visible? Increase in gold and silver prices reflect this. If gold and silver is going up, it means that there is a threat. We don't want to invest anywhere. We will put their money into physical assets like gold and silver. This shows instability and the financial markets. That is the second case. Third case, basically, policy becomes more nationalized. Countries face sharper trade-off between growth. See, one is maintaining India's autonomy. 2, growth. And 3, stability. Maintaining all is becoming difficult because of the geopolitical situation. So what is the economic survey saying? See, there can be 3 repercussions right now in the state we are. One, least probability is everything collapses. What can collapse? Technological, okay, geopolitical can collapse, as well as financial. Everything collapses. That's dangerous. That can happen. That may happen. Second, inward looking, no coordination, and you are more focused on basically in your own say. That is your deglobalization. That means you're not trying to expand trade, you're more inward looking. This can happen. This is there. Third case is basically where countries itself, they become risk averse completely. Okay, so they don't want to take risk. And when they don't take risk, raising money, companies raising money becomes difficult because everybody will be interested in putting money in gold, etc. These are the 3 cases. Whatever is the case, what the survey says is, any of these cases, but the problem for India can be, 1, capital disruption and rupee value fall. So for us, there is a problem. The problem, any of these 3 scenarios, whether it is complete collapse or whether it is inward-looking situation, we will not get foreign investment. If you are not getting foreign investment, what will happen to our currency value? Depreciates. We will lose our currency value, will go down. So for us, the problem is availability of capital and rupee value fall. I hope it is clear. Now, moving forward, I'll tell you something. See, economic survey basically talks about, see, we have current account deficit. China has current account surplus. Okay. To bridge our deficits, we are dependent on what? Capital. That means we need money that is coming in the form of investments, foreign investment. It can be FDI, FPI. That means we are over dependent on foreign investment. Suppose if there is a capital account surplus, like countries like China, where they have surplus, they are not dependent on inflow of capital from outside China. That means they don't want FPI. If FPI comes only, then they'll be doing well. That is not the situation in countries like China. Are able to get this. But for India, what is the problem? Since we have current account deficits, to bridge those deficits, we need money moving in the capital account. So in the capital account, we need FDIs to come in, portfolio investors to move into India. Are able to get this? Okay. So now what is the problem? The problem is there is always this risk or a premium we have to pay. What is the risk? Suddenly these investors can go out of India. That risk is always there. Currency risk is also there. What is currency risk? Whenever rupee value falls, these fellows will not be in India. They will start moving out of India. Isn't it? So this risk is there. If we want to handle this problem, it is not about bank interest rates. See, this is not basic class. Already basics are done for you, first few days. And therefore, some complexity will be there. If we want to really do the economic survey, what is there in the survey? Are able to get this? So, few things, we'll simplify it further what we will write in the exam. See, what I'm trying to tell you is very simple. So, first thing what I've mentioned is, there is a paradox. Okay, what is a paradox? One is very good macroeconomic stability, but there is a problem with respect to my currency value. Okay, this is one which we have discussed. This is the paradox. Second important observation is there is this problem is not just, see, India's case, what about our repo rates recently? Increased or decreased? Decent enough, banks. What did RBI do with respect to CRR rates? Decreased. What about our forex reserve? Decent enough? Decent enough, around how much? Okay, decent enough forex reserves. We don't have any problem here, right? Okay, then that means when the interest rates are lower, that means raising capital should be easy or difficult? Raising capital should be easy for us. It should be easy because of interest rates, this reduction, all this. Is that okay? Then one more observation. Economic growth is good. When the growth is good, okay, then there is something like decent forex, decent deficits, okay, deficits. Investors should come into India or not come into India? Investors should be investing in India, but there is a threat which we see, which is like a paradox, that especially these investors have moved out of India. Which investor? Foreign portfolio investors have moved out of India. This is what is the meaning of it. Okay, when these investors have moved out of India, now see here, these investors have moved out of India, again that is putting pressure on our what? Rupee value stability. Rupee value stability. It is putting pressure on rupee value stability. Now, what is the understanding here? See, the understanding here is what economic survey is saying. Countries like India, we always have these deficits. Current account deficit. To handle this deficit, we are using money from where? From our capital account. That means we are dependent on certain investments, obviously, whether it is FDI, whether it is FPI, or we are also dependent on borrowings from outside India. All this I will put it as something like we are dependent on foreign savings. These are not our savings. Money is coming from outside India. This is called as foreign saving. I think there should not be any problem. This should be clear. Okay, but countries like, that means this you're using for handling this deficit. So this is a long-term problem for India. Long-term problem means unless and until I work here. That means unless and until I become surplus country, focusing on increasing my exports, I cannot reduce my dependence on foreign savings. I cannot reduce my dependence on foreign savings. What will happen if you depend on foreign savings? If whenever they are going out of the country for whatever reason, they are moving out of the country, whatever reason may not be any, see, reason is your stability is okay, but still they are moving out because of Trump's uncertainty, or rupee value fall, or the sudden issues with respect to our markets being overvalued. Whatever may be the reason, whenever they move out, what is happening? It is affecting my currency stability altogether. But countries where, like China, who are very good in exports, number one, they are managing their investment from their savings. Their savings means local savings, domestic savings. China is not even dependent on remittances like India. So they are dependent on their savings. So when they are dependent on their savings, this outflow risk premium, see, there is a risk involved if you are depending on foreign investment. There's a risk involved. Always that risk is there. That risk is what is creating trouble with respect to my currency values and instability. So one, by reducing interest rates, you may motivate and all that. But ultimately, if you want to handle this problem, India should focus on becoming surplus, set its supply chain efficiently so that it will try increasing exports. Its own savings, domestic savings, should become the major factor for increasing growth. This is what the survey is saying. 2017 mains question, savings is an important factor for growth. What are the other things other than savings that will affect economic growth? This was the question. Savings is an important factor for growth means my domestic saving is an important factor for growth. But India's case, my domestic savings alone is not sufficient now. Why? Because always there is this deficit which is there in my current account, which I try to bridge from the foreign savings. That is part of my, that means India is more dependent on foreign savings. Foreigner is investing in stock market means his savings only. Are able to get this? Whether it is FPI is coming in means these investors are investing means their savings they are putting in Indian market. That is what it is. That means we are more dependent on whose savings? Foreign savings in comparison to countries like China, which are less dependent. So if you are less dependent, there is a benefit for us. That means such uncertainties impact will be less on those countries which are less dependent on foreign savings. Now is it okay? This is what the economic survey says. Where will I use such questions like the mains question which we were talking about? That is where we have to use this. Okay, so two things have to be focused. We should, one side we have to focus on our growth, and on the other side we also have to absorb whatever problems that are coming up right now because of geopolitical situations. So here economic policy must focus on the stability of supply, creation of risk buffers, diversification of routes and payment system. Now what should India do to handle short-term instability? Suppose you are, today UPI is used in other countries also. There was a prelims question. Are you able to get this? We have signed deals with UAE where they are buying oil from India by giving us rupees. That means we are reducing the dependence on dollar. Central banks are reducing dollar in their assets and slowly started increasing gold in their asset, in the RBI's balance sheet. Are they doing that? That is also one part of de-dollarization which we are focusing on. Strengthening our supply chain and becoming more efficient, slowly that we increase our exports. Are you able to get this? So this is the aspect which economic survey. This is a preface, this is not the first chapter. This is not the first chapter. This is what the economic survey preface is. It says on one side macroeconomic stability is there, but on the other side currency vulnerability is there. But how do I handle that? This is how I handle it. It is not just possible that RBI reduces interest rates and everything becomes okay, you can borrow money and do things. That's not sufficient. It is a structural problem. Structural problem means you have to handle your external sector. That is, you have to slowly start becoming current account surplus, increase your exports. This is the focus. That is the reason there's separate chapters, how to increase export, what should be done, etc. Is that okay? Understood, no? So I think that should be clear after explaining that. Okay, now one more, now this is, so economic survey focuses on general debt. What is the meaning of general debt? You have central government, state government, and UTs. Okay, all the three put together. Now what the survey says, fiscal prudence is there followed by the center, no doubt about it. That means center was able to project a lower debt to GDP ratios. Debt to GDP. So if you know NK Singh committee's recommendations, debt to GDP should be 60%, both center and state put together. 40 for center, 20 for states. Okay, center touched almost like 63, 64% earlier, and it has reduced it almost like 55.6 in the budget they're talking about. We'll get it down 55.6. That's a decent thing. So that means economic survey, though it says center is doing well, states there is a trouble with respect to their revenue expenditures. This is what the survey is saying. That means states are not fiscally prudent. But our bond yields, now again I'm coming to bond yield, we can't help it. See, general debt means India's government bonds are listed in the exchanges outside India. Okay? So Indonesia and India both have same ratings. Rating means triple B rating. This is called as credit rating. Better is your rating, you should be able to raise money at a lower interest. The economic survey says Indonesia's rating, India's rating, triple B, both are at the same level. But Indonesia's bond interest or bond yields are lower than India. Are you able to get this? Everybody is able to get this. That means what? India has to raise money from the international market. India has to raise it at a higher rate of interest. Though the rating of India and Indonesia is same. Why is that happening? Fiscal prudence is there with the central government. Okay, but still states are not up to the mark. This is also one of the reasons for our bond yields to be little higher. 6.7 and around 6.3. That means, see, what is the problem? 6.7 means when you take loan, you have to give 6.7% annual interest. That means my cost of borrowing is high. Are you able to get this? Is that okay? My cost of borrowing is high. Why is our cost of borrowing high when we are more fiscally prudent? This is also because of states' lack of fiscal prudence. States pose emerging risk by crowding out growth, enhancing spending. That means they are spending on revenue expenditures. This is a problem which economic survey, it affects the cost of overall sovereign borrowing. Overall sovereign borrowing means government's borrowing. Government's borrowing is becoming expensive. In spite of having the same rating as Indonesia, my borrowing cost is increasing because of slight lack of fiscal prudence by the states. The economic survey subsequently discusses what should states do to bring in fiscal prudence. Fiscal prudence means reducing their deficits. Is that okay? Complexity has reduced a little. Is that okay? So this is something like, see, the rating has been upgraded recently. And Indonesia, that means, see here, Indonesia yield is how much? 6.3. India's sovereign, 6.7. Means for me, I have to pay 100 rupees I'm borrowing, I have to pay 6.7 rupees yearly interest. That means borrowing is expensive. See, if borrowing is expensive, what is the problem? Capital is becoming costly means my efficiency will come down. See, government 6.7 means private fellow has to borrow means it will be 7.7 or 8.7. So therefore, for the private fellow, raising capital will become even more challenging. So therefore, production can get affected. Production gets affected, growth can get affected. This is the link of yields. Government bond yield link is not simple. This is like a benchmark. GSEC yield is like a benchmark. Benchmark, you know what is a benchmark? This will decide how corporates can borrow. Corporates can never borrow at a rate lower than 6.7. They have to offer more interest to borrow. This is what happens. This is the significance of yield. Is that okay? This is what survey talks about. subsequently. And debt is increasing. Why debt will increase? Your borrowing cost is going up. Interest payments have to be done. So more interest payments you're doing, that will distort intergenerational equity. Intergenerational equity? Okay, so intergenerational equity, the subsequent generations have to pay for interest payments. So spending on education and healthcare, all that becomes a challenge. Okay, so this is something which I've already. India's high cost of capital is a structural macroeconomic outcome. Okay, macroeconomic outcome means what I have explained. You cannot do it by just reducing interest rates, making bank loans cheaper in India. It will not solve the problem. This is a structural problem where you have to handle your current account deficits. What I have explained. I have written this, this got a problem. So foreign savings dependence, risk premium, and therefore surplus has to be created by increasing your exports. Okay. Till here, I think it is clear. Is that okay? Understood? So here, this is basically services trade matters up to a point. See here. See, India's case, we are good in service exports, but we are not so good in manufacturing exports. What the economic survey says, manufacturing exports have a higher impact on restructuring how economy functions. Why? Why manufacturing has? See, manufacturing will put pressure on logistics. That means government has to come up with logistics reforms. Manufacturing efficiency is dependent on infrastructure. That means government has to build infrastructure. Without proper infrastructure, service sector, you still can manage. Suppose India is exporting more manufacturing goods, means we have to become more efficient in manufacturing. It automatically puts pressure on the state that you have to reform your logistics, you have to reform your infrastructure, you have to reform policies related to labor laws and many other deregulation aspects. That means if manufacturing exports are doing well, service exports are doing well, which will reform the economy or which will create the ecosystem in the economy. Ecosystem, that means you'll be able to build a proper ecosystem. That will be possible when your manufacturing does well. And services will have only a limited impact. And that is the reason the survey says we have to focus on manufacturing or merchandise exports. Merchandise means I'm talking about goods. See, when the compounded annual growth of total exports is almost like 9.4, including goods and services. But manufacturing is only around 6.4. This shows that we are not so good in manufacturing exports. But service export do not impose a lot of pressure on the government to reform the logistics or infrastructure, etc. This shows that yes, there is direct focus should be there on manufacturing. Reason is clear. Reason is logistics impact, infrastructure impact, ecosystem creation. All that manufacturing will put a lot of pressure on state. Services, IT industry will not do that. And that is the reason economic survey focuses more on manufacturing. I hope you're able to get this. So this is also there in the preface itself. All this is preface. Everything is discussed here. Okay, so here, another important word that has come up is entrepreneurial state. So government uses this word that state will act like an entrepreneur. That does not mean state is going to become commercial. You know what is commercial? State is not like a capitalist. But here state has to assume an entrepreneurial state role. So entrepreneurial state is a different kind of state which will act like a capitalist in terms of risk related aspects. So what will an entrepreneur do? He will understand the risks. Okay, he will not give up so easily. Okay, you know one thing is not working for you, then immediately you will shift your plan, adopt something else. Suppose you know your trade with US is getting into trouble, you start signing deals with EU, UK, or maybe 7, 8 other free trade agreements. This is what is an entrepreneurial state. I agree that there is huge amount of risk involved. I agree that there is geopolitical instability, but I will not be paralyzed. Meaning of paralyzed is, I will not sit and cry and I don't think I'm finished. I will start taking small incremental steps. I will take risk towards, I will at least move each step every day. This is what is an entrepreneurial state. This is what government is talking about. Is that okay? It is not about commercialization of state. It is not state capitalism. A state that can act before certainty emerges. See, everybody acts when the destination is visible. Why a startup is difficult, why the role of an entrepreneur is difficult is because I will not be able to see my destination. If you tell me this is your destination, everybody will work. But without seeing the destination, putting in 11, 12 hours of effort, I don't know when the result will come. I don't even know whether the result will come or not. This is what is the risk of an entrepreneur. Nothing is clearly visible and still I keep working. This will help in compounding our effort, which will lead to a growth prosperity. This is what is an entrepreneurial state. I hope everybody has understood. Okay, so for that, here, recent economic surveys have articulated a single coherent and architecture for India's next phase of growth, linking union, states, private sector, academicians, and citizens, along with deregulation. That means it's not possible only if states decides. It's a collaboration between state, citizens, academia, society, private sector, all going together, working towards one single goal. Only then prosperity is possible. This is what the survey is talking about. I hope it is clear. Understood? Okay. Now here, this is the last page of the preface. Okay, here there are two words, Shreya and Priya. This is something like, one is the enduring good. Enduring good will not happen immediate. It will come in the long term. Another one is the comfort zone. Priya, the fleeting comfort. So are you ready for taking that additional effort? Delayed gratification, that means not worrying about immediate gratification and working towards long-term stability. So whenever I take a decision in life as an individual or for a company or even the government, you have two options in front of you. One is a comfortable option, which will gratify, or you will have satisfaction immediately. But that may not have long-lasting effects. Another one is a difficult path, which is an enduring good. It is long-lasting. Are you able to get this? So now the economic survey is clearly telling how the budget is going to be. Simple. Economic survey is telling you, don't expect tax cuts. Don't expect anything like populist policies. This is how the budget was. Don't expect that immediately we will help you out with respect to subsidies and other schemes and things like that. We have decided to work towards more stable and long-term growth of India. This is what is the mindset of the economic survey, which is clearly reflected in Madam's budget speech. Because Madam says, people over populism. In the budget line, Madam says, people over populism. Okay, so what are these lines? Three kartavya, Madam talks about three kartavya. Budget, I'll talk about it later. Tomorrow we'll see. So, three kartavya, in that, before talking about three kartavya, Madam talks about people over populism. Long-term stability is very important. Are you able to get this? So, this is what, okay, so, in other words, the country stands to gain immensely when all of us embrace delayed gratification. All of us embrace means individuals, citizens, private sector. Don't expect private sector. Don't expect any corporate tax cuts immediately. Foreign portfolio investors expect STT would be reduced. It was in fact increased. Okay. Government has come up with labor code reforms, which has increased the cost of the corporates. Adhering to labor codes is also a cost. It has increased their expenditures. In the short term, there is a trouble. But we are looking at long-term stability. So labor code reforms which have been done was also a cost for most of the companies. Companies, when they came up with their profit and loss statements, what you observe is their costs have gone up because they had to adhere to the new labor codes. That means it's all expense in the short term. Are you able to get this? Portfolio investors are moved out of India. 3 billion have gone out. $3 billion in almost like April to December last year, it has gone out. And then you want to motivate them to come to India. Rather, we have to give capital gains tax deductions or STT reduction. Nothing has been done. Rather, on F&O, STT tax was increased by 150%. This shows that immediate gratification is not the role. Rather, we are looking at long-term stability. This is the mindset. Before the budget itself, you can understand after seeing this that yes, don't expect populist policies. I hope you are able to understand. So this is about the preface. Lots. So of course, nobody reads preface, but I generally feel that that is like the head. Okay, rest all is nothing. So you have received any synopsis kind of thing or something? No. Okay, that we can, later any of synopsis will be, you can download the synopsis. Okay. But of course, I will not go ahead with the straight synopsis. From the document, whatever I feel important, I've put in the document, in the discussion. Okay, synopsis is good. Yes, yes. Huh. Good. Somebody is showing me the synopsis. Till here, is it clear? Understood. Right. Okay. Now, this is the first chapter. State of the economy, pushing the growth frontier. Okay. Now, nothing to like, this is simple, more simple to understand here. Now, what the survey shows is, you observe that the growths have been sustained in advanced economies also. That means what? In spite of US coming up with so much of tariffs on so many countries, A is what? Advanced economies. Growth has been there in the advanced economies also. Growth was visible in the advanced economies, according to the economic survey. Okay, but the problem is, US has put most of their money into data centers, semiconductors, etc. So their growth was primarily sustained by investments into a single sector primarily. But growth has been sustained. You do not expect that, no, advanced economies will collapse, but nothing has happened that way. They have done decently well. Okay, so now here, if you see, global economic growth, fragile, delicate, and diverging. What is this? USA's imposition of reciprocal tariffs on imports from its trading partners initially raised fears of slower growth and higher inflation in global economy, but impacts were temporary in short run. This is what the survey is saying. Impact was not so high. It was managed to some extent. Okay, this is what is the survey saying. Issues in advanced economies. Example, US inflation remains stubbornly above 2% with rising unemployment rate. Now, one more thing the survey says is, every country has a different situation. For example, China is facing problems of deflationary pressures. Deflationary pressure? Why? Because of fall in property prices. China, deflationary pressure, see, China is facing deflationary pressure. Okay, so what will happen? See, that is something like what you should understand. See, Japan generally used to face deflation or inflation? Deflation. But right now you find Japan is also having what? Inflation. Okay. US situation, US is facing inflation. Okay. China, when we look at China, China was facing deflationary pressure. Deflationary pressure. And Chinese deflationary pressure is because of fall in real estate. Fall in real estate. China. See, unlike India, if you look at Chinese stock market, people are not so keen generally. If you look 3 years back also, 5 years back, if you see a Chinese stock market results over 10-year period, you will find that their stock market will be like this. Means what? Who will invest means? No. So Chinese also, the rich Chinese also, they will primarily give more preference to real estate. Okay, 21 plus 22, around 22, 23, when real estate prices were collapsing in China, what Chinese did, they started going to Dubai, US, Malaysia, and other places and started buying real estate. So what Chinese government did, it came up with a huge monetary stimulus. Monetary stimulus. Monetary stimulus is why? Because China wants its own investors to come back to China. It wants its own investors to come back and invest in China. If they have to invest in China, what should happen? Their real estate should revive. Their stock market should revive. That means prices should go up, asset prices should go up. Everybody wants to buy when the asset prices are going up. So how will asset prices go? When you inject huge cash. Huge cash. That means people have more cash. Bank loans are extremely cheap. Pumping money into the economy. China did this huge pumping. For that 2 years, the Central Bank of China has built its balance sheet. That means it has created more assets so that it can issue more money in the Chinese economy. China's logic is, after COVID, when US can mint dollars and push into the economy, why can't we? US has mint dollars and pushed. US was responsible for increase in inflation, not just in US, across the globe. US dollar, when you mint more dollars and pump, US dollar can buy properties in Malaysia and Dubai also. You're minting money and pushing money, US dollar can create inflation problem. One of the reasons for inflation after COVID is US Federal Bank minting more money. When you can do it, why can't we? And why should our investors buy properties outside in Dubai or somewhere else? Why can't they come back and invest in China only? They will invest provided the property prices, share prices do well. If they have to do well, people should have more cash. Therefore, start minting currency and give. The balance sheet should be expanded and you have to mint more money, and slowly property prices started going up. Share prices also slowly started going up. This was 1.5 years back. Because of that, FPIs in India, they said we will go put our money in Chinese markets. That time also we had a risk. The risk was our rupee value was 80, 85. That time also that was looking high. 90 now looks okay for us. We got used to it. Tomorrow 100 also number will look okay. 100, no, it's okay. Because once it becomes 120, once it comes back to 100, you'll feel comfortable. You'll feel, okay, 100 only. No, it was 120. This is something like the recency bias, we call it as. Recency bias is, I've seen 120, so when I see 100, it's okay. You feel it is okay, but it's not okay. That means rupee value is going down and down, not just because of many policies. Even this was a reason. Now what happened? Temporarily, some Chinese started coming back. But China could not sustain this. Again, there was deflationary pressure. Deflationary pressure means prices going down. During deflation, manufacturers were not produced. I hope it is clear. Again, deflationary pressure, prices are coming down. So therefore, every price of property, price of assets is coming down in China. This is what is deflationary pressure. Again, they'll think of other markets. So in China, they will keep the interest rates high or low? They have to keep interest rates low to handle this situation. Are you able to get this? Now, countries like Japan, which always used to face what? Deflation. To handle deflation, interest rate should be high or low? Low. To handle deflation, interest rate should be low. But now, Japan is facing what? Inflation. So that means in Japan now, interest rate should be increased or decreased? Interest rate should be increased. Interest rate is increasing means, that means coupon rates are increased. Interest is nothing but the coupon on the bonds. That is the reason Japanese bonds also, yields are increasing. Japan bond yields. One current affair that was there, yen carry cost. Yen carry trade. Okay, so that means in Japan, because deflation used to be there, interest rates used to be very, very low. So what they used to do, they used to borrow money from Japan at lower interest and buy assets in other countries. You're borrowing in yen because your interest rates were less, but you were investing in other assets. This was called as yen carry trade. Yen carry trade means you're borrowing in this country called Japan where the interest rates were very low. And you are investing in US and other countries where your assets you can buy because you're getting loans at a lower rate. Suppose if I take loan here at 0.5% interest and buy US bond, which is giving me 4% return. Are you able to get this? US bond is giving 4.5% return, and here the interest rate is only 0.5% or 1%. I am taking loan in this country and putting my money in US assets. This is yen carry trade. Why was the interest rate so low in Japan? Because Japan was facing deflation. But what is the situation now in Japan? Inflation. Therefore, interest rates started going up. Interest rate means interest rates are going up means interest rate going up means yields are up. Yields are up in Japan. US, again, you observe that yields go up and down. In China, yields should come down. Why? Because interest rates are low. Interest rate, yield go together. Everybody is able to get this. Okay, so interest rate increase means yield going up. Interest rate decrease means yield going down. Is that okay? Right? So, situations are not same, means central banks cannot follow uniform policy across all the countries because all countries' situation is different. This is what the survey is saying. Is that okay? So, situation in China, advanced economy, stubbornly above 2% inflation, like US, like countries. Deflationary pressures in China because of property sector. That means deflation will be there when the demand is not there. Demand is not there, therefore there is deflation. Divergent trajectories of central bank policies across major economy. That means central banks in different countries will have different types of policies because their situations are completely different. To handle deflation, I have to reduce interest rates. Means yields will come down. To handle inflation, you have to increase interest rates. Means yields will go up. That means two different countries, different policies. Is this okay, everybody? Are you able to get this? Okay. Don't worry that private final consumption expenditure is how much. That anyhow is there. That is the most simplest part. Seeing the numbers. Okay, so that's not at all a problem. Till here, I think it is clear, right? So this is something like global growth, fragile and diverging. Diverging, why diverging? Different countries, different situation. Central bank policies will be same or diverging? Diverging. Uniform. So yields would be same in different countries or different? Different. Because uniformity is not there. This is what the survey is saying. I hope you have understood this. Okay? Okay. Now there is one index. Okay, so if you see, this is something like, nothing to worry, you will not draw this in the exam also. This you will not draw. This is something like global policy uncertainty. Okay, so global policy uncertainty, you observe that this index is showing that global policy uncertainty is increasing or decreasing? It is increasing. There's huge amount of uncertainty which is clearly visible. This is what it shows. Another important observation from this chart. Okay, so this is something like global FDI flows, not just India. So these two go together. Whenever there is global policy uncertainty, okay, so this index shows that huge amount of uncertainty. What is uncertainty? Uncertainty means Trump. Simple, no? So I need not define also. I not define what is uncertainty. I can show one person and tell you uncertainty means this fellow. That's all. Why? Because what he speaks on one day will completely change the other day. Now saying 18%, you said 50. Why to increase to 50? Why to get it down to 18? I did not understand. I have not understood the trade deal only. Why? Why did you get it up to 50? And why are we dancing for 18 also? I don't know. We are happy. See, this is what recency bias I was telling you. This is what is recency bias. Everybody is playing with this. If rupee value becomes 120, it comes down to 100. You are very happy. Yes, rupee has come down from 120 to 100. It is like your salary has come down from 1 crore to 60 lakhs. And suddenly, another company gave you 70. Now you find that you are happy. You're happy because recency bias. This happens everywhere. In every decision we take, this is what you see in the Trump's episode, where he has taken it from many items, it was 3% only. 3%, 4%. Everything you picked it up to 50, then you have got it down to 18. We compare with other countries. Okay, China, it is like this, no, 33, 34, we are okay. Vietnam, we are okay. And therefore, India is very happy. And now everywhere in the news, you're saying, friendship. I don't understand where the friendship is. This is like, this is a situation which you observe everywhere. In our results also, in our performance also. In our test scores, which down, and suddenly it goes up a little. You feel that you have improved. No, actually you have come down. But you forget that. This is what is the problem. I hope it is clear. Okay. So coming to this. So this chart shows policy uncertainty is high. Okay. Nothing great about it. This shows in FDIs are going down everywhere. If you observe world over, that means I'll not invest much. You've observed the blue one and the green one. This shows that the FDIs are dropping. Global FDI flows are dropping. Developed economies dropping. Europe, North America. Okay, this is because of, I told you, where is this going? Semiconductor, AI, and only AI. AI bubble blast means it will be more dangerous than 2008 subprime crisis because of this. No jobs. Huge problem will be there. I hope it will not happen. Let the AI live long. It should not happen. If it happens, huge uncertainty will be there. Employment issues, developing economies. So money was going to Latin American countries. Metals, minerals. Okay, it was going to Brazil. These countries. Latin American, Mexico. That is the reason their Latin American index got a return of 60% last year. Like our Nifty. Why? Everybody is going to Latin America. Africa, okay. Okay, Asia also you can observe there's a slight fall. I hope you're able to get this. Is that okay? So this is something like the policy uncertainty. Elevated global economic uncertainty compared to historical. This is due to fragmentation of geopolitical relationships, lower visibility on policy continuity. This is Trump, leading to deterioration in FDI. So global FDI flows have reduced because of increasing policy uncertainty. I hope that is clear. Is that okay? As per Nations Conference and Trade, UNCTAD, World Investment Report, FDI flows declined by 11% year on year. Excluding certain economies, FDI flows have come down. Is this okay, everybody? Understood? Clear till there? Okay. Now there are different deficits which you should be knowing. One is the revenue deficit. Okay, I'll talk about that when I discuss budget in detail. I'll discuss the budget. There I will discuss. But RD is there. You have effective revenue deficit. You have fiscal deficit. You have primary deficit. Okay. You have gross fiscal deficit, net fiscal deficit. You have gross primary deficit, net primary deficit. What does primary deficit talk about? It is FD minus interest payments. Last year prelims also they gave this question. Okay. Now here, what is the observation here? Primary deficits in major countries have increased. Okay, when I look at the data 2021, and if you observe, primary deficits in most of the countries have gone up. Okay, except countries like Brazil and India. Except certain countries, primary deficits have gone up. This is what the economic survey is talking about. Okay, few things here. Uh, One is policy rates in the emerging developing economy. Policy rates means you're talking about repo rates. The policy rates in emerging developing economies, India is a 5.25, Mexico. So you observe that the policy rates are slowly coming down. That means they are focusing on expansionary monetary policy. This is what is one observation. Okay. Then another important observation here is sovereign 10-year bond yields. 10-year bond yields. You observe that bond yields are higher in countries. Japan, it started going up. US, it started going up. India, the bond yields are decent and coming down. But of course, I mentioned some problem there, states borrowing and Indonesia comparison. But overall, if I take 10-year period, our bond yields are coming down. That means our interest rates are coming down. This is what it is. And here, primary deficits are on a higher side, except for very few countries like Brazil and India. Madam has kept a target, let's say 0.7% of GDP, etc. So this is basically our primary deficits are coming down. That is what we observe. Okay, so these are the things which these charts talk about. Okay. So here I'll just mention few things. Okay. 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 Here we see one word here, that is economic statecraft. Okay. So now here few things. Suppose if I ask you what measures have been taken by the government in the recent past to increase economic growth. What measures have been taken by the government? Or India is facing some troubles at the international front, or we are talking about troubles at the external sector front. What are the problems here? Or what should be done, or what has government do to enhance our GDP growth or economic growth? So if such a kind of question comes up, so how do you handle this, and how do you pick up data from the economic survey? This is what you have to see from the data or the charts that are clearly visible. So one is, you should be knowing that when I'm talking about GDP, we can talk about the supply side. Okay, and two, we can talk about the demand side. Okay, so on the demand side, what demand side formula basically? Demand side formula is C plus I plus G plus NX. Everybody would, I think you should be knowing this. This is domestic private final consumption expenditure. Domestic private final consumption expenditure, right? This is investment or gross capital formation. GCF we call it as, okay? So this GCF includes gross fixed capital formation. Okay, it also includes change in inventory. Inventory is goods which you have produced but you have not sold, let's say. It is lying in the godown. Okay, so this is basically what you've produced, but it's still change you're taking. That means at the beginning of the year, you're checking the inventory. At the end of the year, you're checking the inventory again. What is the change you're trying to check? Okay, and then this is government final consumption expenditure. Government final consumption expenditure. Okay. And then this is nothing but net exports. Okay, this I think, this is what the demand side calculation of GDP. Okay. Then we'll come to this. So how about the supply side? Supply side calculation. How do you get GDP? GVA at basic prices plus net product taxes. Okay, so this is how I get GDP. GVA at basic prices plus net product taxes. Always GVA is measured at basic prices. GDP is measured at market prices. That is the reason you find a difference between the numbers also, between GDP and GVA. Why? Because GVA is always, in the basic prices, we don't have net product taxes. We only have net production taxes. Okay, so there's a difference between GVA numbers and GDP numbers, because GVA is estimated at basic price and currently GDPs are estimated at market prices, and therefore the numbers are different. This is something which, if I ask you, so what are the measures that were taken by RBI and government to improve the demand side? So when I write a question on increasing economic growth, so one, I will have the data with me, what is mentioned in the economic survey. We'll come to the data. Before coming to the data, what are the policies taken by government as well as RBI in terms of boosting C, private final consumption expenditure? Can you give me some points? So one is, somebody has mentioned this, that is GST rationalization or GST 2.0. Reducing the GST rates so that consumption can go up. Clear? Okay. Then last year, Madam has come up with income tax deductions, including rebate up to 12 lakhs. Rebate up to 12 lakhs. This is like monetary stimulus only. So reducing income tax rates last year itself. So this is also taken to drive C. Anything else? What else has been done to expansionary, okay, expansionary policy. So if you say expansionary policies of RBI, so I can say RBI has reduced something like the repo rates. Okay, RBI focused on open market operations to inject liquidity. Okay, and also reduce the CRR rates from 4% to 3%. RBI also reduced the risk weights for loan given to NBFCs. Of course, this is something like risk weight means, if you know some formulas like capital adequacy ratio, it is nothing but the total capital to risk weighted assets. According to RBI, this should be at least 9%. Basel says keep it 8. So this RW is the risk weight. Okay, we need not write the technical formula in the exam, but probably you know the risk weights have been reduced means earlier you have to allot higher risk weight for consumer loan. Means higher is the weight means more is the capital the bank has to keep to give that loan. But if the risk weight has been reduced as it is, suppose for example, two things happened here. One, people started taking more of, let's say, gold loans because of increase in gold prices. Automatically gold loans have lower risk weight. okay, in comparison to the regular non-mortgage loans. That automatically has lower risk. This will lead to what? This will also has led to something like credit expansion. Credit expansion is again going to increase my consumption. So here risk weight, if you keep more risk weight, you can give less loan. Suppose asset loan is, let's say, 100 crore. Okay, risk weight is 100%, means my risk weighted asset becomes 100 crores. That means there's a higher probability this 100 crore may not come back. But suppose 100 crore gold loan is there, risk weight is only 50%. That means my risk weighted asset becomes only 50 crores. This is 50%. So my denominator is going to come. So RBI has reduced the risk weights. RBI has reduced the risk weights for loans given to NBFCs, let's say. That means NBFCs can give easy loans. This is what it is. Risk weight is reduced means you automatically the denominator is going to come down. If the denominator is going to come down, then you keep less capital and still give loans, adhering to the Basel guidelines. So that will also enhance what? Enhances my credit expansion. This will give easy loans to NBFCs also, and NBFCs will also give better loans. This will lead to more bike sales, more car sales, more AC sales, etc. All this will also lead to my increase in consumption. These are all measures which they have taken. So RBI reducing the risk weights, or CRR, SLR, OMOs, and government policies to drive consumption. Till here, is it clear? Okay. Now, what you should check in the economic survey? How much was the contribution of consumption to the GDP? How much is the contribution of I to the GDP? What economic survey says is, we are also doing, the growth is sustained by I and C. This is what the economic survey says. Economic survey is saying what? Growth is not just sustained by only C. Growth is sustained by C and I both. I means, that means government, and primarily in this I, who all can contribute to I? Can government contribute to I? Yes. This is basically called as public investment. Suppose madam is saying my capital expenditure is 12.2 lakh crore in the budget. I'm not talking about effective capital expenditure. Effective means again you include the grants also given to the state. So I'm not taking that. I'm just saying only capital expenditure. If 12.2 lakh crore, which is high in comparison to 2014-15 numbers. This shows government has a very logical thought process in terms of increasing what investment. Government investment which is primarily focused on increasing GFCF. I'll build more roads, more dams, more infrastructure. This is the logic. Similarly, you observe that corporates' balance sheets are decent. This is what the economic survey is saying. Corporates' balance sheets are okay, not bad. Corporate balance sheet is okay means corporates can borrow more and also put their money into GFCF. That means Maruti can buy more machines. That is also part of GFCF. Maruti can buy more machines, or the companies can invest into more capital goods, etc. This is what the economic survey is saying. That means the corporates' balance sheets are doing okay. And therefore, third, what government tries to say, forget about NX. If I talk about X, on the X front also, we have not done very bad. We have done decent because India started looking at exploring what? Global markets. It's not dependent only on US economy. We started diversifying. Almost like 7-8 FTAs we have signed this year. This clearly shows mother of all deals, father of all deals they're talking. No? So all that UK, EU, and now your US is also there. US is also in your pocket now. Trade deal in our pocket. So global market expansion shows my X is also not bad. Around 21.2%. This is what the economic survey is saying. That means I had not failed even on the X front. X is what? Export front. So what are the measures taken to boost I or to increase GFCF? See, GFCF is a very important factor. Why GFCF will decide my future growth or potential growth. What is the meaning of potential growth? Potential is not the actual. Potential is what is the potential I have when all my factors of productions are put to work. Okay, so what is the potential growth India can achieve? So the potential growth primarily also focuses on this aspect, which is gross fixed capital formation. See, this is part of what is investment? Investment is something that leads to future output. This investment into infrastructure or more capital goods which are used to produce other goods will increase my future output. Better is my infrastructure, more FDIs will also move into India tomorrow, next year, and that will also lead to increase in my potential GDP. Are you able to get this? Countries with high debt to GDP plus high GFCF, it is decent. That means government is spending more on building infrastructure. Debt to GDP, if you're saying debt to GDP is 82, 83%, 100 rupees is my GDP, if overall debt to GDP is 82, 83%, then if my GFCF is also increasing, then that means we are spending more on building infrastructure, nothing to worry. But if debt is increasing, but this GFCF is not increasing, it means that government spending is primarily going into revenue expenditures or day-to-day expenditure. That is not good for the economy. Debt is not bad. Debt is it leading to creation of assets is one of the important factors that will determine my future growth. If my debt is not leading to creation of assets, that debt is going to be risky because you are taking it for day-to-day usage and that will create intergenerational equity subsequently. Are you able to understand what I'm trying to tell you? Is that okay? So according to survey, what is happening? It is coming from both. The GDP is increasing from both C as well as I. Improvement in C, improvement as well as in I. Till here, I think, is this clear? Okay, now before that. So this word, if they ask in prelims, you should be able to answer. That is about economic statecraft. Okay, so here if you see, so what are economic instruments? So one is economic policy, another one is economic statecraft. This is what the economic survey is talking about. What are economic policies? Like fiscal policies there, we are using our monetary policy, we are reducing our deficits, controlling inflation, promoting growth. All these are basic economic policies every country does. What is this economic statecraft is? This was mentioned in Kautilya's Arthashastra also. I will use economic policy for strategic gains. Okay, so that means my economic policy is not just restricted to economics alone. Okay, so I have additional interest. I will use economic policy to stop a war. I'll use economic policies to ask a country not to buy something from Russia. I'll use economic policy to ask other countries not to buy oil from Iran. Okay, you're using economic policies for results other than pure economics. Okay, for example, here if you see, it reflects rising geopolitical competitions, concerns over technological dominance. For example, China is saying, I will not export rare earth metals. China has put ban on exporting silver and critical minerals. Now, China is a leader with respect to this area. China controls EV segment there, especially with respect to rare earth and critical minerals. So China is very clear that I will focus on these areas where I have dominance. US is good with respect to technology. US is not ready to give semiconductor technologies to other countries, etc. Now, everything is something like you observe, it is not dominance and vulnerability is exposed in traditional global value chains. For example, here, it is defined as deliberate use of economic instruments to achieve foreign policy or national security objectives, such as compelling a country to stop hostilities with a third party or to liberalize its markets. You're asking Ukraine, Russia, stop war. In fact, it has gone to the extent of saying that India, you're buying oil from Russia, and that is the reason why Russia is able to fund the war. Completely illogical. Okay, and that is used as a reason for putting 25% additional tariffs on India. That means you're using economics as an instrument. Tariff is one instrument you're using to achieve your foreign policy or national security objectives. This is what is called as economic statecraft. I think everybody is able to get this. This is what is economic statecraft. It differs from economic policy. So drivers behind resurgence here, so you observe that slowly there is move towards deglobalization or inward-looking policies. Inward-looking policies. That is one important observation which we see now. Okay, nationalist policies. And there is a doubt with respect to multilateral institutions because of global imbalances. For example, nobody talks about WTO anymore. WTO means useless. Simple. Okay, so futile. It's a futile organization, lost relevance. There's no discussion about tariffs, trade barriers. What are we doing now? Okay, so there's complete loss of trust with respect to multilateral institutions. Nobody is ready to accept UN only here. Okay, so here basically there's a lot of lack of trust, and you don't believe now free trade will benefit everybody. The basic fundamental principle of capitalism, that free trade is for the benefit of everybody. This is what Adam Smith, David Ricardo was saying. Now you start questioning those beliefs only. How can free trade benefit us? China, you are at a benefit when you're doing trade with US. Therefore, tariffs. Or US may say, I have a reserve currency with me. My currency is a reserve currency. So therefore, I can't devalue my currency. But China, you are devaluing your currency, making your exports cheaper. So I am at a disadvantage. Therefore, I will use tariffs to counter this. Now, all this is something which you see. Absence of updated global norms on subsidies, investment. So you're following the same old methods and you have not changed it based on the current changing conditions. So this is also one more problem. Intensifying geopolitical tensions and multilateral and militarization. This is increased defense spending. So Japan is one of the safest and peaceful country. And Japan, you find, has increased something like defense. Japan had a history, very bad experience. Now you observe Japan is slowly increasing its defense budget. It's an indication that globe is becoming a very hostile place to live. Because countries like Japan itself are increasing their defense spending. Specifically Japan, because Japan never talks much about defense spending. Are you able to get this? So this is something which we observe. This is what we call it as the economic statecraft. Okay. Is this clear till here? Understood. Now, actually what happens is, everybody from the synopsis reads this. And we expect questions will come from here, agreed. But if I have to write proper mains answers, I have to read the economic survey properly. I think you're able to get this. Okay, so what is happening? What is the mindset of the economic survey? What are they focusing on? Okay, so then comes any of these tables. From these tables, what are the things we will take? Okay, so here, this is basically demand and supply side drivers of growth. So on the demand side driver of growth, we are talking about expenditure side, that is private final consumption expenditure, government final consumption expenditure, GFCF, exports. This is what we are talking about here. You can see this expenditure side component, that is the demand side. Okay, so one clear observation is on the first half of 2026. 2026 means 25-26. First half means April to September. Okay, this is what? First advanced estimate. This is only an advanced estimate. Why? Because completely 2026 March 31st does not come. It's only an advanced estimate. This is called as the first advanced estimate. Are you able to get this? Okay, so it's an first advanced estimate. These are provisional estimates. This is first half of 2026. So in the first half of 2026, if we observe, this is basically what? This is basically real growth YOY. YOY, year on year. Okay, real growth means you're talking about real GDP growth. As simple as that. Okay, so here when we look at growth, expenditure components, okay, so we observe that first half of 2026, you observe that private final consumption expenditure around, growth is around 7.5%, which is a decent growth, and government takes pride in terms of its policies like GST rationalization, income tax, RBI policies, etc. Because of that, my growth is around, consumption growth is around 7.5%. Is that okay? Yes. Then, Gross fixed capital formation. So here you see 7.6 in the first half of 2026. So government's logic is my growth on the demand side is primarily run because of one, consumption, two, investment growth. Investment growth is around 7.6%. Some have doubts like GDP numbers, are they okay? See here, GDP numbers can't be completely manipulated. Remember this. You can't manipulate complete GDP numbers. That's not possible. Everybody has this doubt. Okay, so this doubt is there that how can the growth be so much? How can the growth be so much? No. There may be some errors, omissions, and other problems, definitely there. But at the same time, it can't be completely changed or completely manipulated because 3 credit rating agencies have rated India recently. Okay, that means there is, of course, there may be some minor problems. For example, IMF gave a C grade with respect to GDP calculation or data collection especially. So when it comes to data collection, we are taking the informal and organized sector. Second is the base year also. You're using an old base year of 2011-12. So there are certain things which were taken by IMF to tell that India, your data collection, there is some problem and issue. But at the end of the day here, when we observe, the growth is quite decent. Are you able to get this? So here, gross fixed capital formation. So what are the things? See, prelims questions are, what are the things that will fall in GFCF? Okay, so suppose you are building a house on an existing land that is part of GFCF. Livestock, if you are buying livestock, huge amount of livestock purchased also is part of GFCF. Are you able to get this? Private players buying machines, capital goods, etc. That is also part of my GFCF. Government investment into dams, roads, infrastructure, all that is also part of GFCF. Are you able to get this? Okay. Heavy spending on maintenance. Generally, maintenance is not taken, but heavy spending on maintenance. If there's a huge, see, one is you're building an asset. Two, you're maintaining an asset. Generally, maintenance of asset should not be there in the GFCF. But if there's a huge spending on maintenance, then that will also be considered. Huge spending on maintenance will also be part of my GFCF. This is how prelims questions are. And then GFCF of India, GFCF growth rates have been consistently falling in the last 5 years. Wrong. Are you able to get this? GFCF growth rates are consistently falling means wrong. GFCF growth rates are going up. And our growth which is coming is because of two things. One, final consumption expenditure, which is going up around 7.5. GFCF is around 7. And exports also is doing decent enough, 5.9. Export growth rate. This is growth rates. And if you see first advanced estimates, we are talking about exports at 6.4. And already trade deal is out. And probably some things should change. Let's see. And here you can see 7% and this here GFCF growth of 7.8. What you will remember is for data writing, first half of 2026 is sufficient to support my answer. Okay, so consumption expenditure is growing at 7.5, exports around 5.9, and GFCF investment is growing at a rate of 7.6. It indicates that India's growth on the demand side is because of two important factors. One, consumption expenditure. Two, investment. C and I. So these numbers, some approximate number growth I should know for writing answers. I need not mug up, but I should know the number details. I hope it is clear. Okay. Then what are the, on the supply side, earlier there were questions. Like what are the things that fall in industry, let's say. Okay, what are the things that will fall in industry? Okay, then what are the things that fall in services? And are you able to get this? Here basically we are showing mining here. Are you able to get this? So, otherwise generally we show, where do we show mining? Mining can be shown in primary as well, right? So something you're pulling out from the nature, right? Okay, fine. Here if you observe here, one important observation, okay? Growth rate is a problem in mining. Observe that the growth rate is a problem in mining. Government comes up in the economic survey saying due to rainfall issues, Okay, the mining process could not be continued, etc. That was the reason that they have given. But the mining growth is basically, you can see here, first half of 2026 around minus 1.8. I hope it is clear, right? When we look at manufacturing, manufacturing growth is pretty decent in the first half of 2026, around 8.4%. Manufacturing is quite decent. That means my industry growth is driven by manufacturing. My industry growth is driven by manufacturing as well as construction growth. Industry growth is driven by manufacturing and construction, but there is some problem with respect to your mining growth. You can see this. I hope you're able to get this. Okay, so this is what is one more observation you can see here. If you observe the construction growths around 7.4. So construction is also in my industry. So one problem we generally talk about is manufacturing contribution to GDP. We use a word called muted manufacturing. Muted manufacturing means in 1990s also manufacturing contribution to GDP is around 15%. Now also we are around 16.5, 17% only. This is manufacturing contribution. I'm not talking about industry contribution. I'm talking about manufacturing contribution to GDP. So this is called as muted manufacturing. So government is working on those lines. Okay. Okay, now here you can see real GDP growth rate 7.4%. Real GDP growth rate. Okay, so here you can see real GDP growth rate, first advanced estimate, how much? 7.4%. Madam is talking about next year growth between 6.8 to 7.2, and definitely Madam is confident that our GDP growth will be 7%. But here advanced estimate, if you see, first advanced estimate of 26, this is 7.4%. So this is what we have written here, 7.4. GVA you can see here, GVA at basic prices, growth rates you can see here. We have mentioned how much? 7.3%. GVA growth rate around 7.3%, and GDP growth rate, you can see the GDP growth rate here. Okay, GDP growth rate around 7.4. India reaffirms India's status as the fastest growing major economy for the 4th consecutive year. This is a good thing. So some data when I write in the exam, budget number you should know. So in the budget we are saying 7%. Economic survey has given a range 6.8 to 7.2. But the advanced estimates, we are talking about real growth of how much? 7.4. For framing the budget, we have assumed a nominal GDP of 10 to 10.5%. So all those deficits which we talk about, Madam has mentioned in the budget, whether it is RD, FD, primary deficit, are all on nominal GDP, not on the real GDP. So when Madam is mentioning on the nominal GDP for the next year, that means Madam has assumed a growth rate of nominal GDP for the next year. Budget is always for the next year. 26, 27. Economic surveys for 25, 26. What we have done. Budget is what we are going to do. Right? So 26, 27, Madam has come up with the FD targets. No? What is FD target in the budget? 4.3. 4.3% of what? Nominal GDP. That means you have come to some nominal GDP number. How did you assume a nominal GDP number? Maybe 7% or 6.8% of real GDP growth you have assumed, plus another 3.5% of inflation you have assumed. And therefore 10.2 to 10.5% of nominal GDP growth for the next year Madam has assumed. Based on which Madam has come up with those targets of FD, RD, ERD, primary deficit, etc. So all those targets which Madam has mentioned for the next year is on the nominal GDP. That means inflation we are taking around 3.5 to 3.8 or 4. There's an assumption there. Are you able to get this? This is what is the provisional, this is something like the first advanced estimate of real growth, 7.4. But now you know that our inflation was very low. And that is the reason we ended up with probably 8.2, 8.3 of nominal growth. Our real growths are decent, but our nominal growths are bad. And therefore, government here is not talking about nominal growth. Government is talking about real growths. Our nominal growth was bad because of inflation being very less. Are you able to get this? Nominal. Okay, nominal growth. Next year, expectation 10.5. 10 to 10.5 is nominal. Real growth 6.8 to 7.2, at least we'll reach 7. This is the real growth for the next year. I hope it is clear till here. Is that okay? Yes. Now, so on the demand side, we see what has been done. Some numbers, some data also is required. We'll remember a few things here. Okay, so here if you see on the demand side, private final consumption expenditure grew by 7% in 26, reaching 61.5% of GDP, which is highest since 2012. So one is, we were saying that, you know, private final consumption expenditure was one of the important factor for growth. And the number here is 61.5% of GDP, which is the highest since 2012. This is what is the data saying. So here if you see, two things here. Growth in private final consumption expenditure, highest since first half of 2024. First half of 2024, 6.9. And now you can see first half of 2026, it is 7.5. This is growth rate, growth rate, okay? And then this is share of private final consumption expenditure to GDP. Share of private final consumption expenditure to GDP. So this is around, you will have to remember, around 61%. Around 61%, to be very specific, 61.5, but around 61% is the share of private final consumption expenditure to GDP. I hope you are able to get this. But private final consumption expenditure, when I compare it with 2024, it is around 7.5. Now you may ask, why is government comparing it with 24? Got the point right, 2024. If you compare it with 25, the number growth rate looks lower. I'm not talking about that. So here, see, this is how the data, data is basically, data is data. I can say, this is like more optimistic way of looking at data. Optimistic way of looking at data, you're comparing with, see this first half, it is high. If I compare with this, are you able to get this? Therefore, government has compared it now here half. That means, of course, nothing wrong, but this is how it is. So wherever we are, for example, rupee value also, you will find. Always we need to be optimistic. Government has to be optimistic. And the chief economic advisor has to be optimistic. He can't be pessimistic. He can't say tomorrow what will happen if US again cancels trade deal. The 10% we have put, we have assumed that the 10%, which is the very bad situation, we have only put 10% probability. But other things we have put 40, 45%. 40, 40, 45, 45 is 90%. And the worst one was 10% was the worst thing. We always believe the worst will happen. We never know when will it happen. So when it happens, we say this is falling in the 10%. And therefore the situation has gone out of the hands. But this is how it is. I think it is clear. So private final consumption expenditure, 61% of my GDP. Growth of private final consumption expenditure compared to 2024 first half is how much? 7.5%. I hope it is clear. Now, growth in GFCF. If I see growth in GFCF here, 7.6%. Growth in GFCF, that is investment. So here, GFCF contribution to GDP remains steady. Okay, it has come down. GFCF means what? In my total GDP, what is the contribution of I? In that I, one of the major portion of I is what? GFCF. Plus inventory is there, valuables are there. But primarily it is GFCF. You observe that the GFCF has come down during COVID. COVID government could not spend more, and now we are at a decent level of around 30.5. Are you able to get this? So investment around 30.5% in the first half. So this is quite decent when I look at. So it has continued to anchor growth with share of GFCF estimated at how much? 30%. Share of GFCF 30%, private final consumption expenditure around 61%. This is what you will observe. Exports are also not bad, around 5.9% growth. This is what the data is showing. So what are the numbers you will remember? Private final consumption expenditure growth and contribution to GDP. GFCF contribution to GDP and GFCF growth rates. What is the real GDP growth which we have come up in the first advanced estimate? Around 7.4. What is the madam's target for the next year? Around 7%. Nominal GDP target around 10 to 10.5%. There should not be any difficulty. Exports are contributing to around 21% of my GDP. Okay, last 10 years, GFCF is continuously coming down, means wrong. GFCF is increasing after 2020. Okay, last 5 years, consumption is coming down, that is also wrong. Why? Because my consumption growth rates are also going up. These are trend-based questions which you have to check the graphs for. Is this okay? Understood? Yes. Okay. So this is sectoral contribution to GDP, and this is share as a percentage of nominal GDP. Share as a percentage of nominal GDP. Okay. So here you can see, this is already I asked you to remember, around 61%, which is, okay. And investment around 30%. Okay, this is one thing. Now come to production, supply side. So on the supply side, supply side is a production method. You're talking about the outputs of agriculture, industry, and services, and their contribution to nominal GDP. So here, when you look at the contribution to nominal GDP, obviously which sector? Services around 53.6 in the first half of 2026. You can see this, okay? And industry around 24.3. 24.3. Now manufacturing around 13%, but government says around 17% on real terms. This is nominal terms. This is nominal term contribution of manufacturing to GDP is 13%. You can see here 13. Government is saying around 17% on the real terms. There's a separate graph also given. So manufacturing contribution to GDP is around 17 on the real terms. This is on the nominal terms which you see here. All this is nominal. Is that okay? So here you can see services 53, you remember, and industry around 24, agriculture around 13.2. This is in the first half. So first advanced estimate, if you see, you are looking at agriculture at 15.2, industry at 24%, and services at 51.1. That is what you have to remember. 51, 24, and 15. Approximate numbers only. Is that okay? Yes. So here, what I have written here, these are, of course, these are not there in your synopsis. These are called as high frequency indicators. What is the meaning of high frequency indicator? Suppose if I write a point, my economic growth, if my economic growth is calculated or it is manipulated, I can say my economic growth is not manipulated because other high frequency indicators also, there is an expansion which I can see. For example, domestic demand, YOY, you can see some high frequency indicators, demand is coming. How do I know urban demand? See, urban demand can be seen through FMCG sales. FMCG is fast moving consumer goods, right? 2, you can see the number of UPI transactions here, UPI transactions. Okay, passenger vehicle sales. These are some things which are, we call it as high frequency indicators. So high frequency means, the whole logic of high frequency, whenever the growth is there, these are indicators that there is demand in the economy. So on one side, if my growth is increasing, but these high frequency indicators are not doing well, it means there is some trouble with respect to demand. But here, when economic survey is saying, see, my growth is supported by high frequency indicators. So urban demand is supported by domestic air passenger sales, passenger vehicle sales, FMCG sales, UPI transactions, etc. Rural demand also, you can see three-wheeler vehicles, tractors, two-wheelers, FMCG sales. So these are something which are indications that yes, there is demand in the economy that is decent. This is what economic survey is telling you. So high frequency indicators are also, there is a growth which clearly indicates that my growth is quite decent. Okay. Now here, what the economic survey says about agriculture. Okay. Agriculture is seen as a shock absorber. For example, during COVID, when all other sectors were going negative, the only sector which was doing well was agriculture. So it acts like a shock absorber when the things are not going properly. So now what the economic survey says is, agriculture we are quite decent, we are growing at 3.6%, but when I look at our average growth, we are falling behind our average growth. Our average growth is around, let's say, 4.5, but we are falling behind our average growth. This is one. Second thing, when we look at our agriculture growth, you observe that the crop growth is coming down, and there is a growth which you see primarily in the allied sectors, especially livestock. So the growth in agriculture is being sustained by livestock or the allied sectors in agriculture. This is what Ashok Dalwai committee was also saying. Ashok Dalwai committee was talking about doubling farmers' income. If you really want to double farmers' income, you can't just depend on crops and double farmers' income. You have to look for alternate revenues for the farmer. Especially you have to focus on allied sectors like livestock, fishing and other things, dairying. Okay, so all this, you observe that the economic survey is saying the growth rates are clearly visible in the livestock, though the growth rates are dropping when it comes to crop. Is this okay? Yes, this is one observation. Now, sectoral growth, you can see this is something which we have already discussed. So mining going negative. Okay, overall industry around 7%, you can see here. Construction around 7.4, manufacturing around 8.4. Some data. So where to take data for writing answers? Economic survey first chapter is the best place where I can collect some data for writing answers related to sectors of economy. So there are always questions in mains related to sectors of economy. For those questions, okay, so this is how it is. Agriculture, very simple, 3.6, but lower than the average. Livestock growing at a faster pace than the crop. This is what I observed from there. And manufacturing growth mentioned around 8.4. Mining and quarrying, there is a negative here, minus 1.8. Is this okay? Understood? Now, this is where the data, when the slides are given to you, later you will note down some data. Okay? You need not remember everything. You'll remember the first half and the advanced estimate check once. That's all. Okay, whatever is mentioned in the budget, something that is we are going to achieve in the next year. Okay, now here this is basically services growth. See here, one important observation in services. So services growth here, first half of 2026, how much is the percentage? 9.3. Is that okay? Services growing at 9.3. Okay, then here you can observe financial, real estate and professional services growth around 9.9. Okay. So one important observation, services growth always as usual growing at 9% plus. Is that clear? Okay, so that is what is the understanding here from this particular aspect. 9.3. Manufacturing we have put 8.4. Okay, so manufacturing we have put 8.4. First half. Okay, overall industry definitely your first half is around 7%. Industry around 7, overall industry. Services around 9.3. Agriculture was not so okay. We are expecting 3.6. 3.6 is the growth, which is lower than the overall average, which is 4.5. I hope it is clear. These are the three numbers which I have to remember. 3.6 is that okay? Yes. Okay, so the growth rates in financial year 2026 have been sustained by growth in manufacturing and services. Can I say that? Manufacturing around 8.4 you are seeing, and services around 9.3. This is what is the observation, right? Second, services estimated to grow at 9.1 in the financial year, indicating broad-based expansion across the sector. Manufacturing expanded by 8.4, reflecting resilient demand conditions and expected improved utilization of existing capacity. Is that okay? Then construction around 7.4. Mining contracted by 1.8. Gone negative. That's it. There is some data for the exam. Okay. So agriculture GVA grew by 3.6, but it is lower than the average growth of 4.5. That's it. Okay. Government is comparing with the 25, we are saying we are okay, but I'll not say we are okay. Average when I take, we are lower than 4. lower than 4.5. So therefore, we have to work on agriculture, as simple as that. Okay, so government is showing last year recorded financial year 26 was only 2.7, so now 3.6. That's not my concern. 3.6, but 4.5 we are lower. So therefore, my growth is sustained by one, manufacturing, two, services. This is what is the crux of this data. Sustained from manufacturing and services. Is that okay? Yes. Now, few things which become important for prelims, which you have to go back and check. See, there are indicators which are going to be changed. For example, one is our GDP base years. GDP base years, national account rebased to 2023, changes contemplated in new GDP series. Okay, so basically change in GDP base years is one discussion which is going on. Second, with respect to CPI also, CPI is what? Consumer Price Index. CPI rebased to 24 with state-specific item baskets, wider price coverage across urban and rural markets. And we are also going to reduce the weightage of food. Food basket. Major chunk of my CPI is food. And they are going to reduce the CPI food weightage also. And also there is the base year which is going to be changed. This is one. There's another index, which is Index of Industrial Production. IIP we call it as. So Index of Industrial Production is a volume index when it comes to manufacturing. Volume, that means if I'm comparing last year Jan with this year Jan. So we are talking about volume growth. So it's a volume index. And IIP also, we observe that there is improvements proposed in the new series. Okay, so in the IIP index also. So you observe that government is coming up with few changes with respect to the data estimations also. Okay, one CPI, another new GDP calculation. Okay, government is also talking about producer price index. Of course, not still implemented. PPI, you have WPI and CPI. Now they're talking about PPI, which is producer price index. Heard of it? Okay, so producer price index considers both goods as well as services. But our WPI index only considers goods. There are no services. WPI problems of double counting is also there in WPI. That also is reduced or removed to some extent in the PPI index. So we are basically talking about producer price. So producer is there, then it goes to the wholesaler, and then from there to the retailer. At the wholesale, at the producer level, you are calculating it is PPI. At the wholesale level, you are estimating it is WPI. At the retail level, you are estimating it is CPI. In CPI, again, you have CPI combined, CPI industrial worker, CPI agriculture labor. Okay, so these are different CPI indices. We are talking about CPI combined here. CPI combined means CPI rural plus CPI urban. Okay. So this is basically to tell you, since this is mentioned, so these are important for prelims. So that means concepts which are important for prelims can be one related to IIP. Okay, two, it can be related to CPI and PPI, Consumer Price Index. Okay, then CPI base year changes, etc. These are important. Okay. So Ministry of Statistics and Program Implementation, MOSPI. Okay, so here, here just a simple mention, which I felt like the e-Sankhiki portal provides access to over 770 indicators covering 18 statistical products and comprising approximately 136 million records sourced from MOSPI. That means for better data collection, they are using different portals, and some portals are mentioned in the economic survey. Some portals are mentioned in the economic survey, which will increase the efficiency with respect to my data collection. This is mentioned in the survey with respect to data collection. Just to mention that, I've just mentioned that there is a separate box which was given where it is talking about these aspects which will help in better data collection. Okay. Now some few basic understanding here. Okay, so here we are saying our macroeconomic fundamentals are good. We have talked about growth. Okay, so another macroeconomic fundamental that looks decent is inflation. Okay, so here if you see, this is about inflation. So if you observe, one is headline, core, and core inflation excluding gold and silver. So what is headline? Overall, including food and fuel, right? Core inflation means more stable, excluding food and fuel, right? So here you observe core inflation excluding gold and silver. How much it is? 2.9%. Okay, core inflation around 4.3%. Overall core inflation. This core inflation is above 4, including what? Including gold and silver. So gold and silver was abnormal. It was abnormally leading to increase in my core inflation. That is the reason government has mentioned without gold and silver also, excluding gold and silver you can see here. Headline CPI you can see, headline inflation, headline CPI, 1.7. And primarily my headline is coming down because of food inflation which has come down. Are you able to get this? Headline is coming down because of food inflation which has come down. You can see food inflation. Okay, so here core inflation also is quite decent, excluding gold and silver, around 2.9. Taking gold and silver, it is around 4.3. Headline CPI around 1.7. Everybody knows headline and core inflation. There should not be any confusion. And 1.7 is a very decent number when it comes to CPI inflation. Is that okay? Yes. Now that is what is, this is basically consumer price food inflation. Okay, so consumer price food inflation which has gone down. And that was basically responsible for getting my headline inflation down. Is that okay? Yes. Is that okay, everybody? So data, this is data. Data is boring, but we will use these numbers in answers. Got the point? That is why I'm showing, because this is a synopsis. No, the first chapter is more like synopsis. Now, from the second chapter, it is more like specific to that chapter only. There's no trouble there. But here it is not like that. In the first chapter, all the chapters are covered. From the growth to inflation to monetary policy to deficits, everything is covered in the first chapter. Okay. So here if you see, favorable 1.79 correction, vegetable and pulses prices supported by favorable farm conditions. Okay. So you can also see that the inflation is less because of the base effect also. Base effect is what? Comparison effect also. Base effect also. Base effect is comparison effect. So, and core inflation has exhibited persistence largely influenced by price spikes in precious metals. This is higher if you see. If you observe from 2025, it is higher, but this is purely because of gold and silver. This is what they are talking about. Purely because of gold and silver. If you remove gold and silver, we are decent enough. There's no much spike in core inflation. This is what budget wants to tell you. Economic survey wants to tell you. If I remove gold and silver, if I compare with the previous year, there's no trouble. Is that okay? So this is what the survey is trying to explain. Okay. Clear till there? Now talking about gross tax revenue, what is gross and net? No. When it comes to gross and net tax revenue, how do I differentiate gross tax revenue and net tax revenue? Net is after giving away the revenues to the states. From the total gross tax revenue, certain amount of money you're giving it to the states, isn't it? So net is after giving away those revenues to the states. As simple as that. Okay. Now, out of my direct taxes and indirect taxes, maximum revenue for the central government, you know it is coming from income tax. And out of 100%, major chunk is direct taxes. This is something which you should be knowing. Okay, overall, direct, then you comes indirect. Indirect also it is. Direct is income tax, then you have corporate tax, then followed by GST. Income tax, corporate tax, and then GST. I hope it is clear. So income tax is one of the major source of revenue for the government, especially the central government. Major source of revenue for the central government. I hope it is clear. Okay. Now here, gross tax revenue, the direct tax collections reaching nearly 53% of the target by November 2025. Okay, so we have reached 53% of the target. Indirect tax collections remained robust despite lower inflation and import volatility, with gross GST collections recording multiple all-time highs during the year. So what are they trying to tell you? Though we have reduced the rates, etc., even GST tax collections were quite decent. Okay, so this is what it is. So recent tax policy reforms, we've already talked about this, GST rationalization, income tax reductions last year, etc., that was done by the government. 3 credit rating agencies have given a good rating to India. This shows India is following fiscal prudence from BBB minus to BBB. It shows madam is following fiscal prudence. 3 credit rating agencies have improved our rating. If they improve the rating, what will happen? You should be able to borrow money at lower cost. Simple logic. So debt will become cheaper subsequently because our rating has been enhanced. This is what they want to tell you here. I hope it is clear. There's no confusion there. Simple. So that is also clearly reflected in the bond yields. If my ratings are improving and I'm following fiscal prudence, that means my yield, government GSEC yield, government should come down. I should be able to borrow at a lower rate, no? Lower rate. So I should be able to borrow at lower rate means yields are falling. This is what is. So market acknowledged government's fiscal prudence. This is how it is. So I can say, like, the proof is what? That government is following fiscal prudence. The proof is because of this declining 10-year bond spread over US bonds. This is over US bonds indicates lower risk premium. Over US bonds. This is a comparison with US bonds. Are you able to get this? Okay, so our yields have come down and this shows that, okay, fine, we are pretty okay with respect to yield. But as I mentioned earlier, the comparison of India with Indonesia, that is because government was talking about states' fiscal prudence. Both have the same rating, but for them their yield was 6.3 and ours was a little higher, 6.7. Are able to get this? This was another comparison which they did. So here, this is about, of course, we'll discuss monetary transmission in that subsequent chapter. But in the first chapter, there is a discussion what they did with respect to monetary transmission and changing credit mix. Now, what is the understanding? I'll tell you. See, corporates should depend more on banks for loan, or they should be able to borrow more from market. Which one is a good thing? Got the question? Corporates, if they depend completely on banks, it is better, or they should be able to borrow money from the market. Market. That means corporate bonds are getting some demand in the market. Then what will happen? Corporates can raise loan from the market only without completely depending on banks. So headache for banks will also come down. Especially infrastructure loans are there, which are long term. So it is always better that they raise money from the market. Why? Infrastructure loans, for banks it is difficult because it leads to asset liability mismatch. Banks we put deposits only for a short term period. But infrastructure loans we give for 15 year, 20 year. Banks do not have the capacity. It leads to asset liability mismatch. Liability means deposits, asset means loan. Loans are given for 20 years, but deposits are only coming for 2 years, 3 years. For banks, there is a problem of asset liability mismatch. If the bond market is good, then they can raise money from the market itself. That's a good sign. So here, what is the observation? Overall flow of financial resources to commercial sector in India from non-bank sources. From non-bank sources, they are going up. Slowly, see here 7.7. Slowly from non-bank sources, you are able to raise money. This is what it shows. You not remember the numbers, but you should understand that corporates are able to raise money from non-bank sources. Is that okay? Understood? This is what the chart is telling. Is that okay? So here you can see, later it went down, but again it's recovering. Non-bank sources are able to raise money. So this is one. Sectoral deployment of credit by scheduled commercial banks. Okay, so generally they are giving more of personal loans. You can see here, the yellow one is personal. Okay, personal loan. Okay, then you have services. Then you have NFC and other things. Okay, so NFC increase is very important. NFC is what? Non-food credit. So the country has to grow means there should be more of non-food credit. So non-food credit. NFC is basically non-food credit. Okay, if the non-food credit is recovering, it means it's a good sign in terms of credit expansion. I hope it is clear. So that is what it is. So few important observations. We are doing well. One, liquidity infusion was done by reducing CRR, 2.5 lakh crore. OMOs around 6.9 lakh crores was injected by RBI. Okay. Forex swaps was also done around $25 billion. Okay, swap I will discuss in the subsequent chapters. Gross NPAs have declined. Gross NPA and net NPA both have come down. Gross NPA is the total NPA. Net NPA is gross minus the provisioning done by the banks. So what you observe is NPAs for the banking system have come down. So multi-decade lows of 2.2%. Okay, so this is what. And economic survey also talks about slippage ratio. I have not written it here. Slippage ratio, SLIPPAGE. See, what is provisioning? Provisioning is from the bank's own money. Banks are putting money aside to handle what? Bad assets. This is what is provisioning. I think you should be knowing this. See, provisioning, so in the economic survey, 3 things were mentioned. So one is liquidity infusion. Liquidity infusion. So liquidity infusion, this is basically through what? Reducing CRR, reducing repo rates. Okay, around 6.95 lakh crores injected through OMOs, open market operations. All this is what? Liquidity infusion. As simple as that. We're putting it. So this will lead to growth, consumption, and many other demand. It will increase demand, etc. So this is one important aspect. Then when you're doing this, are your NPAs going up is very important, because it's not about banks giving loans. It's also about banks' health being stable. So the bank's health being stable, how do I know? I know it by checking few numbers. Right? One is gross NPAs. Are they going up? Okay, or coming down? Net NPA. Okay, so are they going up or coming down? Or PCR ratios. PCR is provisioning coverage ratio. Provisioning coverage ratio. See, provisioning, see, net NPA is equal to gross NPAs minus bank has put some money aside, provisioning, to handle bad asset. NPA is bad asset. To handle NPA, bank is putting some money from its own funds. Okay, so this provisioning coverage ratio should at least be 70% as per guidelines. 70 means 100 crore bad loan is there. On an average, at least 70 crore should be provisioned. So that if that 100 crore tomorrow is not coming back, bank should not collapse, because already you have provisioned up to 70% of your bad loan. This is what is provisioning. Okay, so when NPAs come down, gross is coming down means provisioning will also come down. Provisioning is like expense only. Your own money, you're keeping it aside to handle NPA means that money can have been used for something else. Your money is getting locked, no? So provisioning looks good, you're provisioning, but at the same time, provisioning, excess provisioning will reduce profitability. When NPAs come down, banks will become more profitable. They need not provision much. And they're also giving more loans. So economic survey also says that slippage ratio is coming down. Slippage ratio. This is also related to, UPSC will not ask what is the concept. Generally, you should know it is related to NPA. Slippage means the rate. What does this ratio check? It checks the rate at which good loans are turning out to become bad. The rate at which good loans are turning out to become bad. That means before the starting of the year, I am checking what is the loan given. And at the end of the year, I am checking the NPA. Okay, so what is that you observe? For example, if last year slippage ratio was, let's say, 15%. Okay, this year slippage ratio is only 13%. What does that mean? Last year, 100 crore at the beginning of the year, in that 100 crore, 15 crores have become NPA. The rate at which good loans are turning out to become bad. This year, out of 100 crore in the beginning of the year, only 13 crore have become bad. That means my slippage ratio, the rate at which good loans are turning out to become bad, has come down. So the economic survey says NPAs are coming down and also the slippage ratios are coming down. So at least I should know slippage ratio is also related to NPA. It measures the rate at which good loan means what? Payment of interest or principal on time. So beginning of the year it was good, but at the end of the year you find that it is turning out to become NPA. This is what you are checking at. What rate good loans are turning out to become bad. So that slippage is coming down, and also NPAs are also coming down. This is what the economic survey is talking about. So bank's health is quite decent in spite of doing all that, in spite of all pumping money, etc. Is this okay? Understood? Okay. So I think you should be knowing what is NPA and all that. Okay. So now here if you see, external sector projected to be stable, but headwinds persist. Headwinds persist. This is what the economic survey is saying. So external sector looks to be okay, stable, but headwinds, some problems still persist. Why? Because global impact. So now here, what are the data points which I will remember? Okay. So here if you see, service exports increased by how much? 6.5%, whereas my merchandise exports increased by 2.4%. Okay, this is what is one data point which I will remember in the first half, that service exports have gone up by 6.5, but my merchandise exports have gone up by only 2.4%. Exports only. You're not remembering the imports here. So this is something. Then, one more important observation here, though FDI inflows are coming, there is huge amount of outflows also. So India's case, the problem is inflows are there, but outflows are also clearly visible. In the last 1.5 years, you observe that there is inflow and there are a lot of outflows also that is happening. Outflows primarily with respect to FPIs, which are moving out of the stock market. So here if you see, remittances have surpassed gross FDI inflows in most years. Remittance has become a very important aspect for handling our external sector balances. That means huge amount of remittances are moving into India, and most of the years our remittances have surpassed gross FDI inflows. This is what the economic survey is saying. So that they were using this word, no, remittances are more like, don't call it as brain drain, it is brain deposit. Our external affairs head was saying this, no, so everybody is going abroad, so it's not, we keep saying, no, why are you going? And it is brain drain. More than brain drain, he was using this logic of brain deposit, that a lot of money, because they're working there, remittances are coming, and that will lead to economic growth. That is leading to our key source of external funding. I hope it is clear. Our current account deficit is around 0.8. Deficit is there, obviously. It's not that deficit is not there, current account deficit is there, and that is around 0.8% of GDP in the first half of 2026. That is April to September. Around. By December, it's around, we see that it is 0.8%. So capital account, within the capital account, gross FDI inflows continues to rise significantly. Gross, the word is gross. Net means the problem is there are a lot of outflows also visible in the recent past. They have repatriation, money moving out, have marginally declined. This is what it is. So our problem is not about FDI inflows alone. It is also about outflows moving out of India. This is what it is. FPIs, they have been weak due to elevated uncertainty and increased interest rates. So other countries' bonds are giving higher returns. Then safety is important, uncertainty is there. So investors are moving out of India, buying US bonds. They can buy bonds in other countries which are giving them good interest rates. And currency risk is also not there when they buy in dollars. When you're buying in rupees means rupee risk is also there, because rupee is depreciating at a faster pace. This is one of the reasons why almost like 3.9 billion has moved out of India. FPI flows. Okay, economic survey says it is a decent amount, but it is a huge amount. If it would have been decent, rupee wouldn't have depreciated like that. I think you got my point. Economic survey will not mention that it's a huge amount, but definitely it's a huge amount which has moved out. FPIs have moved out of India. That is what it is. Weak rupee, widened BOP deficit. So widened BOP deficit, this is because FPIs are moving out of India. So this widened BOP deficit is putting pressure on my rupee value depreciation. This is what it is. Okay, so, but we need not worry because our forex reserves are quite decent and we can cover 11 months of import cover. 11 months of our imports. This is what we can do. Okay, so forex reserve cover over 11 months of import as of 16 Jan 2026 and approximately 94% of our external debt. So that means if 100 rupees is my external debt, $100. Our forex reserve can cover up to $94. So we are not at a threat. We need not worry that we'll get into some problem because though there are problems with externally, there are problems. Current account deficit is around 0.8. Though there is some trouble with respect to outflows of foreign investments, rupee value falling, we need not worry much because we have around $700 billion of forex reserve, which is helpful in covering almost 11 months of our import. This is what the survey is saying, and which will help us to cover almost like 94% of our external debt. $100 you have borrowed, suddenly nothing is coming. You have sealed everything also. I'm in a position to pay $94. This is what the survey is saying with my forex reserve. So therefore, our external sector is projected to be stable though in such a condition also. So here two things, one export growth, merchandise and services growth. This is one. Then how much of reserves we have? Then current account deficit around 0.8. Though FDI gross flows are there, there are outflows also. This is one problem. As mentioned by the surveys, most of the years our remittances are surpassing our FDI inflows. This is what is the crux here. Of course, this is basically about CAD, current account deficit. 0.8 you will remember. Net private transfers you can see, always positive on the top side there. You can see the green one there. Okay, so always positive. You know that remittances are in the current account, NRI deposits are in the capital account. So these are basics which you should be knowing, current account, capital account, which one falls where. Is that okay? So here you can see positive aspects here. Okay. So services trade balance you can observe, the blue one, services trade balance is above 0. Generally always positive is what you see with respect to services trade balance, observe. Merchandise trade balance you can see, that is basically my trade deficits or goods related area where you find that the charts, the red one is always generally down. That means there is a deficit here, clearly visible. So my current account deficit is primarily because of trade deficit. Trade deficit, this is what the chart is trying to tell you, but still we are in a decent situation. Is that okay? Understood? 2 minutes. I also have a class, huh? So, because this chapter itself, this is the first chapter, no? This is the most important, I say, but important as well as the most difficult because it is a summary of all the chapters. A lot of data is there. Okay, so labor market developments. This was also discussed in another chapter. So a few important crux only we'll see here. 2 minutes I will leave you. See, labor market development is basically a lot of changes have been brought in. What are the changes? One is the new labor codes have come into picture. Okay, the new labor codes also focused on few important aspects. One is the recognition of gig and platform workers. So to enable their registration and inclusion within social security schemes. So this is basically for formalizing non-traditional forms of employment. Another important observation is World Bank's revised international poverty line for extreme poverty is $3 per day PPP. PPP is what? Purchasing power parity. What $3 can buy in US. Okay, we're going to check. What is PPP? Suppose I take a basket of same items. If that basket is coming for $1 in US, if that basket is coming for 40 rupees in India, then my PPP is $1 is equal to 40. Whenever we measure poverty, we measure it at PPP levels, purchasing power parity levels. So those who are getting less than $3 a day, you're calling them as extremely poor, let's say. This is what world. So $3 is not 3 into 92. Which is my nominal exchange rate. It is what $3 can buy. It is the PPP exchange rate. So earlier it was 2.15. So for extreme poverty, it is $3 now. Okay, if But for, if I have to measure lower middle income poverty, it is around $4.2. Those who are earning less than $4.2 a day, you call it lower middle income poverty. But extreme poverty, less than $3 a day. Okay, so one important figure is World Bank revisited the international poverty line, and based on the revised, India's poverty rates are estimated at 5.3% for extreme poverty. 5.3% for extreme poverty. Okay, so based on the new guidelines, the number is quite decent. That means we have reduced poverty. Okay, so 5.3% for extreme poverty. But when I look at lower middle income poverty, here, this is around 23.9. This is what the data is saying. Okay, so way forward, we'll talk about this in the subsequent class. See, this is not for general studies. Okay, so not for general studies, but there is something called as TFP, total factor production. Okay, so, and there is something like, if you would have heard of capital output ratio. Heard of capital output ratio? How much of capital is required to produce 1 unit of output? Higher the better, lower the better? Okay, lower the better. Okay, that means capital output ratio will tell you the efficiency of your investment. If the capital output ratio is lower, your investment will become more efficient. Okay, so what government talks about is, see, one is we bring in reforms with respect to labor, we bring in reforms with respect to capital. For example, I'll just give you a small example. Suppose Chaayos as a company has produced and increased its output by 20%. But it has increased its labor and capital by only 10%. But its output increased by how much? 20%. Okay. Now, this additional 10% increase is not because of increase in labor, nor it is because of increase in my machines. But there is some other magic that has happened, which has led to increase in the output. Okay. So I'm talking in layman's terms, I'm not using any technical word here. Okay, some magic has happened. So that magic is not about increasing the number of machines. That magic is not because you have pulled in more labor also. This is what happens to a country also. So at what rate I convert my basic raw materials using labor to output, without increasing the inputs like labor hours, without increasing the machines, that is capital stock, but still my output can go up. This is what the economic survey talks about in the last paragraph, which is part of this equation. You need not worry about the equation. So for India, I'm not adding more labor hours, but I'm not adding my capital stock. I'm keeping them same. And still if there is an output increase, which is happening, that can be because of cumulative effect of few policies which the government has taken. This is what they start talking about. I think it is too much now for you. In the next class, I will talk about it. That means, for example, reforms and all this is what is leading to that increase in output. Okay, so that's all for today then. Thank you.